Hello guys and welcome to My Way to Fire. Another video from this series where I explain different abbreviations and terms commonly used in investing and finance. We have already gone over PE ratio, what it tells you, how to calculate it, what companies you can use it on and some other ways it can be helpful. This time we will step it up and have a look at PEG ratio. That's the next step, because it stands for price to earnings to growth. It is a valuation method where we use the PE ratio and add the expected growth to the formula. This way we should get a much better indicator than from the standard PE ratio. So how do you calculate PEG ratio? First you have to calculate the PE ratio. We already know that we have to divide the price of a single share by the earnings per share. Now you have to divide it by the expected growth. The calculations may differ because it can be done in multiple ways. For example, you can use historical growth rates, or different time periods such as 1 year, 3 year or 5 year expected growth rates. Let's show an example of two companies to demonstrate how this works. Company A's price per share is $40 and earnings per share are $2. That means the PE ratio for Company A is 20. The growth is 5%. 20 divided by 5 is 4. So the PEG ratio for Company A is 4. Company B's price per share is $20 and the EPS is $1. That means that the PE ratio is exactly the same as Company A's. But the growth for Company B is 25%. The PEG ratio for Company B then comes to 0.8. What did we learn from this? Although both companies share the same PE ratio, Company B has a better growth and thus looks like the better choice here. Peter Lynch wrote in his book that the PE ratio of a fairly priced company should be equal to its growth rate, resulting in a PEG ratio of 1. From that we can deduct that if the PEG ratio is lower than 1, the company might be undervalued, and if the PEG ratio is over 1, then it might be overvalued. But in both cases you should make a much better research on the company and not rely on this metric alone. Let's also mention the disadvantages of the PEG ratio. A lot of well-established companies don't offer much growth, but on the other hand they can pay a solid dividend, so although they may be a good addition to your portfolio they might have a high PEG ratio. Also be aware that the growth rate is an estimate, so it can prove wrong. I hope you learned something new. If you found this video helpful, please let me know by clicking the like button. Also, if you are interested in more money-related videos, then make sure you subscribe and help me grow this channel. It would mean a lot. As always, thank you so much for watching and I hope to see you in the next video.